What's going on YouTube? In this video, we are going to talk about Enphase, ticker symbol ENPH. Year to date, this company has been beaten down. It is down 52.57% over the course of 1 year, down 56.76%. So real quick, business overview of Enphase is, they're a global energy technology company that designs, develops, manufactures, and sells a microinverter-based solar plus storage systems. The company's semiconductor-based microinverter system converts energy at the individual solar module level, which provides a number of advantages over traditional solar panel systems. That includes increased energy production, improved reliability, and enhanced monitoring and control. I believe they're pretty well known for their microinverters, and they've got this new microinverter coming out, the IQ8P, and they're targeting small commercial market, North America, Europe, emerging residential markets as well. A couple of headlines too that they are expanding into like Australia, and also there's just a lot of good news coming out of this company telling us, and maybe it's just because the stock's been beaten down so much that they're just trying to produce some sort of news. And obviously this is from other people, but this is what this comes from the company saying, oh yeah, we're seeing a lot of strength coming from Europe and recovery in the US, which might be true, but one of the biggest headwinds for this company is the high interest rates, because people typically need to borrow money um, to install solar on their house or business or whatever the case may be. So most people are like, I don't want to pay, you know, potentially 10% on interest for solar when it's not going to really save me any money, because it's going to cost me more money to install this solar than it would be just to have an electric bill. So, I mean, it's got some headwinds ahead of it for sure until interest rates potentially pull back, hopefully in the near future. But, time will tell. So, but that doesn't mean that revenue is just going to completely shut off in this company and get cut out entirely. Um, Solar is very desirable in many, many areas, and it is also, there's a lot of benefits. There's tax incentives and, state incentives and stuff like that to encourage you to want to put solar on your house or on your business or whatever the case may be. So they've got a lot of that stuff going too. So, but we're gonna look at their financials. We want to comb through their financials a little bit here and see how things are moving over at Enphase. We've got our revenue, gross profit, net income, all three trending higher, like exploding higher by the looks of it. Net income is joining, which is good. It's better, whenever you see revenue grow, you always want to see your net income follow. Maybe not the same rate, but definitely want it to trend higher. Their gross margin trending higher. I mean, they're sitting at 40, what's that, 44%. Their net margin has gone from negative to positive. They're sitting at 20% net margin. That's pretty good. Um, Revenue and gross profit year over year change. Looks like they're slowing down. Obviously, kind of makes sense because of the interest rates and stuff like that. There is some slowdown, which it makes sense as to why there is a slowdown in the company currently. Return on invested capital currently sitting at 23%. Solid return on invested capital for the company. Again, I mean, these kind of throw the graph off quite a bit. It makes it look a lot smaller than what it is. But, they went from a negative return on invested capital and popped up positive, and they're kind of trending lower, but stabilizing. They've stabilized around 20 and starting to turn higher again. So good to see. So we've got our cash to debt. So we have quite a bit of cash over the company. Not enough cash to cover our entire debt like we've had before over here. Really only one time, but not too concerning at all. Obviously, this is including all debt, long-term, short-term debt, and almost enough cash to cover their debt, which is pretty good to see. So our net income to free cash flow. So this is what I don't like to see, is a higher free cash flow than net income. So personally, this is something that I will be looking deeper into, because I want to know why is our free cash flow higher than our net income? But all things aside, we can see how things are trending on this company overall. Their net income is just trending higher. Our free cash flow is just exploding higher as well. So good, all good things there. Share count dilution also kind of exploded, but has maintained a relatively flat share count here, for the last 4 years. So pretty good. Nice to see that. Our capital expenditures though are exploding, but If you look at our capital expenditures, you're talking about $100 million, $92 million in capex. So nothing to be too concerned about there at all on the capex. Very nominal amount, especially when this company is doing $2.8 billion in revenue and your capex is $92 million. Like, okay, who cares? So that chart can do whatever it wants for a little while and not gonna have to worry about that one. So the main concern that I have is gonna be this, our free cash flow. So we're gonna pull up their earnings statement and figure out and kind of go through that real quick and figure out why that is like that. So we're here on the cash flows on their most recent statement. The biggest, so here's our net income. We had 304 million. This is over the 6 months, and we had depreciation, amortization, pretty big number there. We have 113, well, almost 114 million in stock-based comp. So that's a pretty big number that we want to keep a close eye on. Year over year, though, it is up still, but it's staying relatively consistent around 100 mil in stock-based comp. So, if they can calm that down, but this is a growth company, and that's usually to be expected. We have accounts payable down here, which is another big one, but these are all things that come from changes from assets and liabilities. So anything down here is nothing that is really that concerning at all. So really all we've got is just changes to the assets and liabilities, which accounts for some of it. And the rest of it, I would probably say, is all accounted for in stock-based compensation. So our increase is probably stock-based compensation and some of our changes in assets and liabilities. So uh, nothing to be too concerned about at all. I don't think, this is relatively normal. The only thing we'd like to not see so much of is stock-based compensation there. The main concern on this chart was our free cash flow was greater than our net income, but nothing that isn't too unexpected there for especially for a growth company like Enphase. But overall, financials looking good. So we have actually four other comps. We have Tesla, SolarEdge, Teradyne, and I'm not sure what that company's name is, but ENTG. On Enphase, we have our shares outstanding year over year are growing. We just saw that. We're aware, but only by 1%, which zero or less would be better, but that's part of it. Again, this is a growth company, so it's kind of expected. Operating cash flow is greater than our net income, which we just went over, so we're aware of why that is. Market cap is kind of skewed because of Tesla being on the list here. So obviously Tesla sells solar. Kind of hard to read that chart here with Tesla on the list. Revenue, gross profit, and income, again, a little bit difficult to read. Obviously Tesla's got several sources of income, but it is a solar company, so we might pull Tesla off this list and come back to these two here shortly. But our growth rate, SolarEdge appears to have a much bigger growth rate, especially on EPS side of things. But across the board, we're looking at everybody here has a decent growth rate except for ENTG. Their EPS has a nice growth rate, but their revenue not so much. But everybody else has a lower growth rate than what SolarEdge does, except for Tesla. But again, Tesla's a little bit of a different animal in this case. But there is solar tied with Tesla here. Gross margin, looking good. Operating margin, very good. Profit margin, very good. Free cash flow, we're going to pull Tesla off because Tesla's screwing everything up. Return on invested capital, though, fantastic. And look at this PE. 31 is still a bit rich, actually. But better than Tesla or ENTG over here. So in terms of PE on these lower three here, we're within, we're like 6 points away from and the lowest one here, SolarEdge. So Enphase overall on this chart here is dominating everything. So let's pull Tesla off this list real quick, and I'll come back to the comps here. So now we can get a better, more clear view of some other more solar type companies and not have Tesla on the list here. So now we can see our market cap. Enphase is the leader, but not by a whole bunch. And it looks like revenues as well, kind of all within reach of each other. Unfortunately, Enphase is actually the lowest on the revenue side. So you can see the revenue over here again. Revenue is lower than the other few companies. However, they do have the highest net income. Yeah, they do, barely. So, um, based on these two charts, I wouldn't say Enphase is anything too much better than the other companies, right? And then their growth rate here, we can see a better growth rate across the board, you know. But again, once we come to these margins and stuff, Enphase just dominates the competition here. You know, we have our gross margin up at 44%, profit margin 22.5%, profit or our operating margin, our profit margin 20%. You know, Teradyne here actually is kind of right. I think Teradyne is more of a competition to Enphase than anybody else by the looks of it so far. So maybe Teradyne's worth a bit of a look as well. But we have our free cash flow here, leader in free cash flow, return on invested capital. You know, this is TER, Teradyne, if I'm correct. I believe that's the right name of the company, but that might be worth a bigger, deeper dive into that company as well. So maybe we'll add that to the list next. Now we're here at the calculators for Enphase. So Peter Lynch gives them a fair value of $192.40 per share. Multiples comparison, we get $274.42 per share. Probably add Tesla back in there. I don't know how much is that. Okay, it's basically zero. Manual PE, gives us 17.8 years before we earn our market cap minus cash plus debt. So, really, really good there. Price to book, very well below our 5-year average price to book. PEG ratio, a little rich currently, but forward looking, very undervalued on this company. Graham's valuation, we have an intrinsic value from Graham's valuation of $29.69. So one thing we could do if we wanted to, we could throw a 1 in there, but you know, typically on this growth value here, this is more of a higher growth company, which we have an EPS growth rate of like 49%. So it is a higher growth company. So a 0 is probably more appropriate for this valuation method, even though it does give them like $30 per share. So I mean, I don't know, one's probably more accurate because even with a higher growth rate, um, you know, it's still this isn't a company that's only worth $30 per share. You can tell you that right now. So we'll keep it at 1. We'll give them a 1 on that. Discounted cash flow price per share. Analysts have a price target or a growth rate of free cash flow of $41 per share. Their average growth rate is 209%. So I didn't match the 41. I gave them 30% growth rate. We can see their free cash flow growth rate has consistently grown. So maybe 30% is not quite fair, but it still gives them a very good discounted cash flow price per share of $217. Rule 72, we have our current EPS of 393, and our growth rate across the board is phenomenal with an average growth rate of 38.3% EPS growth rate. So 38.3 goes into 72, 1.8 times, 1.8 goes into 10 years, 5 times. So that tells us we can double our current EPS 5 times over. So I I put in 125 for our future EPS, which gives us a fair value of $2,394 per share. Now, obviously, this is one of those times where you're like, you got to step in and say, no, not gonna happen. So we're gonna give them like a 50 once and see where 50 puts us. So even 50 puts them at a super rich value. So again, I want to make this more of a fair valuation. I don't want it to skew it like that, even though that's what it's telling me. So we'll give them a 15. So at a 15, which I feel like is fair, I mean, you're talking from where they're at now, that's not, I mean, they could probably do that in just a couple years. So I feel comfortable giving them a 15 for a future earnings per share price, right? Which gives them a fair value of $287.39 per share. So our final valuation here on Enphase, we have 6 different valuation methods, actually 5 because we don't have a dividend on this company. But every single valuation we gave them is green. The only one we manipulated was the Benjamin Graham one from $30 to $200 per share. So that gives us a fair market value on this company of $234.68 with a purchase price of $164.28. That's a 30% margin of safety. And right now, you could do a 50% margin of safety almost on this company. It's trading at $120 per share. So, I mean, you saw the financials. You saw everything trending higher, not lower on this company. And analysts have a price target on this company of $218 per share. So we're kind of within range of where the analysts are sitting as well. So, you just obviously do a deeper dive within the company to understand what the company does. Always do that. Always do the other side of the fundamentals here. But the financial side of things here, they look very good, very, very good. And the previous analyst or time we analyzed this company on the financial side of things, we had $328 per share and to $129 buy price. So some of the numbers we had before here, we had a Benjamin Graham value of 130, 209. So this is where well, we got such a high value before is must have gave them a higher Rule 72 future EPS on the company. Obviously, between then and now, analysts could have had a much different EPS growth rate as well. So it could have been a lower growth rate, whereas now they might have changed that to where it's a higher growth rate. But our Peter Lynch value here, 192 is what we got now. We're at 118. Multiples, we had 224, we're at 275. Discounted cash flow, almost flat. And our Benjamin Graham value here, a little bit higher than where it was before. So based on the Benjamin Graham one, I'm going to have to assume that the EPS is what changed the most across the board on these valuations. So maybe 906 here was not a fair valuation to give Enphase, which potentially skewed this number so much higher. So now in this instance here, what we could kind of go back and look at and say, okay, 906 was not a fair number to give them. That's something that shouldn't have probably been on there, honestly. It probably should have been closer to within the realm of where everything else was, because that is manipulative to where a 38% growth rate in this company for the next 10 years is not, that's not very correct, right? So when you value companies with that particular valuation method, you kind of need to adjust it to where things are, where everything else is, in a sense, right? If it's automatically adjusted to where it's close, then I'd leave it. But if it's going to be $2,000 and it's currently trading at $120 per share, well, okay, I got some work to do. So, and that is the fair market value we got. You saw how we got there. We can see analysts are right there as well. And this company is trading about $100 below fair market value, and it's got great financials behind it as well. But now let's take a peek at the stock chart. We have a support zone here of somewhere between 108 and $120 per share, in that range. And this company has just gotten destroyed over the last handful of months. And to me, it looks like with how much it's sold off into support, this seems to me like this is a fantastic buying opportunity, even if it's just for a swing trade. I believe right now this company it appears to me like it is found its bottom. It's doing a triple bottom retest, and I think it's going to take the next earnings to potentially push this thing out of its long-term downtrend here. So we can draw this line. It's potentially something like that. It's pretty steep, right? So if we chop around here for a little while until earnings come out, which I believe is end of October, so about 20 some odd days away, 3, 4 weeks away. So this is on a weekly chart, so another 3 more candlesticks come into here. And I think that is a prime opportunity for this stock to potentially pop higher out of this downtrend that it's got going on. So personally, I probably own way too much Enphase, and I'm probably going to add a little bit more here. Um, in what I truly believe, based on financials, based on just the valuations that we went through, I believe that this thing is going to continue and push higher. So I'm willing to put a little extra money into it to, make my bet on it. Again, this is a long-term hold for me anyway. So I'll probably add some to my long-term holdings, just to probably dollar cost average. I believe I'm dollar cost averaging around 150, 50, 55 range probably. So I probably might add a little bit more in the 120 range here. Get my DCA down just a smidge bit more and then see what happens and go from there. If you found value in this video, drop a like, subscribe, comment, and we'll be back later with another stock analysis video.